Good morning, everybody. Welcome back to the Opportunistic Trader. It is Thursday, October 18th, and we're joined by Phil Flynn of the Price Futures Group and Fox Business Contributor. How's it going, Phil?
I'm doing good, buddy. How are you today?
I'm good. I'm good. We got markets moving around, and we got to get into the energy market, which is your forte. I know you've been on with us, and you've been bullish for a long, long time now, and we've seen
hmm
a significant pullback here. We traded up in. I'm looking at December contract. We traded up to about $77, and a
hmm
few minutes ago we were trading down at 68.55. So that's a significant pullback. What's been driving the pullback, and where do we stand now?
I think it's a combination of factors, and we see this quite often when we get closer to the expiration of the contract. Yesterday was the options expiration on the crude oil. You had a lot of people that were, playing the $70 strike price on the upside and even on the downside. And when the stock market sold off earlier in the week, it pushed crude out of its upper trading range, which was like from 73 to 77, push it in the lower trading end of that trading range, which allowed the market to have a chance to wipe out all those $70 calls on the expiration. So we were close enough for shouting for that to happen. We got a report from the American Petroleum Institute on Tuesday, which showed that crude supplies fell. So the market kind of rallied back up to 72. But the market didn't believe it because the whisper number about the EIA report seemed to be a little heavy. And sure enough, you got this shocking report from the EIA that showed the crude oil supplies built over 7 million barrels, which is absolutely crazy. Or 6.4 million barrels. So, I mean, that was kind of a blindside situation. It allowed the trade to really drive those options. And today you're probably seeing some follow through, margin call selling. So we're probably, getting a little bit of a squeeze play to the downside. Um, in fact, today, if you look at the daily chart, this is the first time the price of crude hit the lower Bollinger Band spread since August, and so we really are at the lower end of the range. Going back to August when this happened, it was the same type of situation. Oil had been up at 74, 75 before the 4th of July. 4th of July passed. You got talk that OPEC was raising production. The market sold off. And then you have this big August swoon in price, if everybody remembers that. We went down to, let's see what that price was, if I remember correctly. As luck it would have it. But basically around 62 area, or either 64 or 62, and we double bottom there. And then, of course, we went straight up and we were making new highs in a couple of weeks. So I think what's happening today is that same type of a situation. We had a big build in inventories. We had a lot of money in options. They were trying to squeeze everybody out of the options. They, get all the longs out of the market, and then we got to get through the expiration of the November contract, which goes off the board on Monday. And then the question you have to ask yourself is, do you want to be long or short oil going in the winter? When you have a situation where you're going to have Iranian sanctions start to kick in the high gear. You're going to have falling production in Venezuela. You've got distillate demand that's 11% above average before winter sets in. You've got supply 3% below average. So we'll probably do what we did in August. We'll kind of find a bottom in here in the next day or two. And then we're going to probably be making new highs again, maybe by the end of the month or early November. So this is kind of like a weird cycle that we see on oil. Everybody gets long, everybody's bullish. Remember, you and I were talking, Mike, a couple of weeks ago when oil was up at 77. We're hearing all the guys coming out, $100 barrel oil,
Right. Exactly.
and where are they now? Are they still $100 a barrel? And I was telling you even then, when we were at 75, I said, we could pull back, we could go up, we could stabilize here a little bit, but we're not looking for $100 a barrel. We're looking more for 80. And so, and that's why a lot of times when you're trading this stuff, you got to be prepared for pullbacks. And when, for example, if you're long, you're heavily long, you just don't want to be long without, protection on the downside. Sometimes if you have long positions, should have it hedged with options if you're trying to be a position trader, so that when you have a sell-off like this, you can use it as an opportunity to readjust your position, and either get more long on the pullback, or at least survive the pullback until the market starts to turn. I mean,
Well, we started to see spec positions pick up big time when we were near the highs. I know
right.
trend followers were long. Any sort of trend model was long oil pretty heavily. And now, the long-term trend followers are still long, but the shorter-term, medium-term guys are kind of getting chopped up, and we're getting to interesting levels here, especially when we're down here at 68.55. I mean, it's well over a 10% retracement from recent highs, and it happened pretty quick. It was only about
Yeah.
10, 12 days ago, that trading days, that we
Yeah.
were up at that $77 level.
Right. And if you remember, we've had this happen 3 times. I mean, you could use that same percentage drop that we saw from the 4th of July to mid-August, the same percentage drop you saw after Memorial Day. So this is how this market works. It takes the stairs up, the elevator down, and then they blow everybody out, and then everybody thinks, oh my gosh, the bull market's over. All the fundamentals for the long term are wrong, and then you realize a few weeks later that we're going to have the tightest oil market we've had in a generation, and the market will recover. So, yeah, I think it's par for the course, a good correction. If I had to bet you when the bottom's going to be in, if it's not today, or it'll probably be tomorrow, because once that November contract goes off the board on Monday, you're going to be trading the December delivery. And you can make an argument like for the December, November, we got plenty of supply right now. That's going to change. Refiners are going to be out of maintenance next month. You're going to have a big surge in exports next month. The Iranian oil that they're dumping on the market is going to be off the market. So you're going to see a much tighter
What
situation.
would it take to make you bearish oil? Is it
I
something
mean,
price action? Is it something news? What would it take?
it would have to be a substantial slowdown in economic growth, because this is a demand driven rally, and you got to look at, even if you look at the International Energy Agency, the globe, even if the economy slows down, we're going to be producing or consuming over 100 million barrels of oil a day, right? The world can barely produce 100 million barrels of oil a day. Okay. So, I mean, we don't have any room for error. Spare production capacity that we can bring online if demand goes up even more is non-existent. Okay. So I don't see a scenario in the short term from just a pure supply and demand situation where we're going to be able to meet demand. So the underlying fundamentals on this market is bullish. I guess in 2003 or 4, crude had a big sell-off. We went from $40 to $30. And then you could ask me the question, Phil, what is it going to take you to be, bearish about this market? And to be honest with you, I would have answered you the same way today. I mean, right now it would have to take a major change, because we're in the same situation in 2003. Yeah, we had corrections along the way, right? We had corrections in 2003, 2004, 2005. I can name you a ton of corrections that happened during that run up, but it didn't change the fact that if you're looking at the big picture, oil went from $10 a barrel in 99 to $146, so at what point in there should you have been bearish long term? Short term, I mean, that's a different thing. What's your trading mindset? If you're a long-term trader, you don't want to be short this market, because over the long run it's going to go. As a trader, you want to push and pull. You should be buying the pullbacks, right? Buying it when there's blood on the streets, buying it at this lower Bollinger Band. I invite everybody to take a look at the Bollinger Band on the daily crude, just a slow, put up a basic Bollinger Band and look at every time that you've pulled back to this number, How many times did people dump out at the low? You know,
On last Friday, Mark Fisher was on with us, and he'll be on with us again
yeah.
tomorrow. And he actually mentioned about being bearish crude at that point. For one
Hmm.
reason that he was hearing possibly was, with all the Saudi news, everybody's been looking for upside catalysts, that maybe this is going to be an upside catalyst. But he was actually saying maybe this is a downside catalyst, because what might actually happen is um, Saudi Arabia, the president has been very vocal about wanting Saudi Arabia to pump more oil and get oil prices lower. That in a way of Saudi Arabia basically saying, I'm sorry, we did screw this thing up. We're going to pump a lot of oil to, lower oil prices, make you happy. Let's just, kind of try to brush this under the rug as much as possible.
Absolutely agree. Absolutely agree. And I think he makes a great point. The and that's what Saudi's going to say they're going to do. They're going to say, hey, he screwed up here. They've already sent him millions of dollars on some kind of deal. The day after Mike Pompeo flew to Saudi Arabia. Oh yeah, we had that. Paid. We were going to do that anyway. So yeah, the Saudis are going to be doing everything they can to make Donald Trump happy. The problem is can they for a sustained period of time? The answer is probably not. Now you're right. Maybe short term that can knock us down. And listen, Mark Fisher's right. Hey, listen, if you were doing a day trade or a swing trade for $2 or $3, if you wanted to catch that move, it was a great move. There was plenty of time to jump on that thing. I mean, it was very clear on the short term charts. Um, you know, I wish I could share this with you. We just got a report on the actual Saudi production numbers over the last few months and their ability to really raise production. You realize, the Saudis, we look at Saudi numbers and they say, oh, Saudi has raised production. But if you really get into the data, they're not raising production as much as they're taking oil out of storage. And so it raises the question, how much more can the Saudis pump? Um, they can release more oil out of storage, but if you look at their actual storage numbers, they are starting to fall pretty dramatically. And so, yeah, I agree with them. Short term, that's a bearish situation. It's definitely something they're going to try to do, but their ability to do it, especially on a sustained basis, I don't think they can.
Right. All right, let's move to some other stuff here. Global equity markets. Right now, S&P is down 21, Nasdaq's down 90. VIX is trading 1880. Yesterday, we had about a 40-point range in the S&P. We started trading very heavy, similar to the way we are right now in the morning. We're down pretty heavily. Then I had a solid comeback in the afternoon. What's your thoughts on where we stand in the equity markets?
We're really down on the Asian stock markets. There wasn't really a main driver for the markets. I mean, what are we talking? Day trade, short term, long term. Big picture here. The Dow being down 150 today. My bet is that we're going to, we've seen a lot of volatility the last couple of days. This has been relatively quiet. We're following the outside markets. My bet is that we're going to probably later in the day turn the market around and close higher in the day. And you're saying, well, Phil, why are you saying that? Because right now we are in, especially if you look at the S&P and the Dow, very tight trading range since the big drop. Right now we're having an inside day with inside of those ranges here. I don't think there's enough negative news out there to really drive the market lower. And so technically you want to be a buyer down here. Now, so we're actually not right maybe at this level. I'd like to see it sell off a little bit more, get to the lower end of the trading range. Now, I'm not suggesting that people necessarily buy this, but if I just had to throw some numbers out at you, I mean, one of the numbers we're looking at on the S&P is 27.8275. That's kind of our aggressive buy point for the day. Not everybody should do that, obviously. If by chance the market on the S&P got up to 2834 and a half, we'd be looking to be a seller. So because we think we're in a range-bound market here today, and we're not looking for a major move up or down, buy the breaks and sell the rally. So we're hoping to get a little bit more of a break and then ride it up to the upper end of the range. And heck, if we do get a big rally today, we probably are going to want to sell it because it's going to probably work to go back down.
What do you think? Fed came out with their minutes yesterday, talked about inflation a bit. Yields right now, the 10 year is at 320. If we start to take out 325 again, is that going to be something that worries the market?
Yeah, for a few minutes or a day. The Fed basically signaled that all of the noise, what the market took that as is that the Fed was going to continue to raise interest rates. We saw an immediate impact. The dollar started to rally off of that. We saw some of the commodities break a little bit on that, and so we're in a rising rate environment. And are people going to get nervous if it spikes up dramatically? Maybe for a day or two, but I step back and look at the big picture. I think a rising rate environment is appropriate. Even though Donald Trump says he's screwing with the economy, right? But I think it's what the market is demanding here, and I think that the overreaction to the increase in rates, I think, is going to level off, and so uh, I don't see it as a major deterrent to the stock market rally. Obviously, the concern is that if you look at the history of the Fed, they have a tendency to screw things up, where they get too aggressive. Um, but really, if you look at the preponderance of the economic data, it's great everywhere. The only weakness in the data that we see is in the housing side, which might be a red flag. But every other sector, manufacturing, energy, you can go on and on. I mean, we're just seeing a solid, situation. Consumer goods, for example, very solid. And companies are getting something that they haven't had for a long time, which is pricing power. That's something a lot of companies were crying about for the last 10 years. We have no margins, now we have strong consumer confidence. Companies are getting some margins here, very good for profitability, very good for stocks. At the end of the day, the stock market is an earnings market, right? And we are in a very good earnings environment right now, and I think that's going to keep the market on solid ground.
Yeah, well, it's definitely picked up volatility, which is good for trading. Yields right now, as I just mentioned, the 10 years at 320. The S&P is down 19, futures down 19, NASDAQ futures down 86. We'll keep an eye on all that. Phil Flynn, thank you
Very
very much for
fun,
joining
very
us.
fun. And I can't wait to see Larry's debut on Price Links. We're very
Yes,
excited.
that is
Today,
coming up. Yesterday, he
today,
filmed that with you.
today.
We'll be playing it on the Opportunistic Trader. Larry and Phil were talking yesterday, so when that is
Woo-hoo.
uploaded, we'll have that for everybody to watch.
All right, there you go.
All
Good
right,
stuff.
thanks, Phil. Talk to
Thank
you
you,
later.
buddy. Bye-bye.